how has the nature of mining finance changed? With me now at the Mines and Money Conference in New York City, Doug Groh. He is a portfolio manager over at Tocqueville, a frequent panelist on my discussions here at the shows. Not tomorrow, but I'll catch you next time, Doug.
Sure.
You'll have to make it up to me. Thank you so much for joining us.
Well, thanks for having me. It's good to be with you this afternoon.
So let's talk about financing and mining.
All right.
It's tough times out there.
It is. Investors don't want to invest in gold mining companies these days.
So what is one to do?
What is one to do? I think what we're focused on is the intermediate sector, companies that have a path to development and have a good strategic plan, and those that we can see are going to create value over time.
Doug, has that always been Tocqueville's strategy, the mid-tiers?
Well, we invest across the spectrum. We have exposure to Newmont and Kinross, some of the bigger names, but we think we can really create value for our shareholders through our exposure to the intermediates and some of the juniors who have a good profile in the marketplace.
You mentioned Newmont, obviously at the center of some of the largest mega merger talk we've seen ever in this industry. Is the mining industry gearing up for some major changes on the discovery front? What do those mergers signal to you?
Well, I think it's probably a little bit early because they have to settle out with the new assets they have, and they're trying to figure out where to deploy the capital that they now have on these new properties. Kind of interesting enough, Premier Gold had a nice drill result the other day, and that's a joint venture with Barrick. And as I understand it, Barrick is putting a little bit more effort to that property, that Nevada property. So it looks like if there is, a good indication of positive results, the capital will be there from the majors.
Doug, you and I have been in this space for at least 10 years now. So if I ask you to compare today to a decade ago, how is it different?
Well, I'd like to compare it to, say, 2 decades ago. At the end of the 1990s, it's, to me, very similar. Back then we saw LAC and Homestake get taken out. There was no interest in the space. The cost of production was basically equivalent to the price, which is not too dissimilar to where we are right now. And there was that consolidation underway. I'm picking up little conversations of capital formation to perhaps promote a property or try to create value in what has existed in the past several years as being somewhat of a dormant entity. Compared to 10 years ago, we're clearly down and out.
Doug, but if money is not going into the junior mining space, how much of a red flag and potential headwind is that for the future in terms of finding new deposits?
Well, I think what it presents is a situation where the gold price is going to rise that much more dramatically, where metal prices have to really rise to encourage that capital to come in and do exploration and do development type of work. What's kind of interesting too is that heretofore we've had the easy assets discovered. The properties that were available to the marketplace have been explored and developed and they're producing. Now it's becoming a lot more difficult to find not just an ore deposit, but in the right jurisdiction, and the people and the capital.
So that mix, finding that mix.
Right.
I also want to talk to you about the gold price today. We saw a very positive GDP number come out.
Right.
Surprisingly, that day, gold did not suffer the consequences of what that number could have otherwise, done to the price of gold.
Right.
Were you surprised by gold's reaction?
I was surprised with the GDP number. I mean, it was a little bit more robust than I expected. Gold has been a little bit on the back foot here in the last several weeks since we got into April. Gold seems to be kind of taking its seasonal cue from the marketplace and saying that, well, maybe we'll just go a little bit quiet to dormant for a while and see a pickup later this year, the middle of the year.
But could this signal more tightening from the Fed, and would this be bad news for gold down the line?
Well, I don't see the Fed tightening. The posture in the world market is for other central banks to ease. So that should be very positive for gold. And, in some regards, we broke through some technical support levels on gold at 1285 or 1290. And one would anticipate that gold should maybe go lower as a result of some of the other actions in the marketplace. But gold is actually holding up really quite well. It's holding in there at 1280. It doesn't want to go lower. It looks like there is some real fundamental interest from central banks, from investors around the world that are looking at the equity markets and saying, hey, record highs in equity markets, record lows in the gold markets. It makes sense to sell high and buy low. Gold presents that.
So overall, if I had to ask you to wrap up your sentiment, Doug, do you feel good about the space right now?
I think fundamentally it's real constructive for investors. I would like to see a more robust gold market, gold price, but it's not detrimental to these companies. They can make money. They're showing in the first quarter that they're profitable and that they can manage their balance sheet.
That's something that we've brought up, in the panels we've been on also, is that, people really think you need a huge rally in gold prices to see a takeoff in these miners and eventually make money for yourself. But that's not necessarily always the case.
Well, I think there's this mindset in the marketplace that the gold price has to break through 1370. And with that breakthrough, I think then investors will start, a more broader market of investors will start to pay attention. The generalists will come in.
Doug Groh, it's always a pleasure speaking with you.
Good to see
Thank
you.
you so much for joining me here. And thanks for watching. We'll have much more for you on Kitco.com.